Hello, everyone, and welcome to the full course on index investing in India. By the end of this course, you'll be able to understand how the index investing concept works. You'll be able to pick your own ETFs or index funds in India, and you'll also be able to see my biggest picks and my top holdings in my portfolio as well. I've built a portfolio of close to 2.5 crore rupees over the past 5 to 6 years, and I have learned along the way that the best practice, at least for someone who's in their 20s or 30s who really want to focus on building a life outside of the charts, outside of the stock market, the best approach is index investing, because I feel that during these years, during these decades of your life, you should be building a strong family, you should be building a strong business or a strong career, whichever applies to you, and you should be building a strong fitness and health routine. So those are the three pillars that I would like to focus on, and hence when it comes to investing, I just invest in the index. And what this means is that I am not stressing about beating the index. What I'm more interested in is tracking the index. This is a more passive investing strategy, and hence it gives you back time, it gives you back energy, and it gives you back freedom to focus on things that you really enjoy. Maybe you're in your 20s and you just want to travel the world. Maybe you're in your 30s and you want to build a strong foundation to start a business or to build a family. Those are the things that really matter in life, is what I personally believe in. And hence I've moved from various strategies, from stock to swing trading, and finally from actively managed mutual funds to now index investing. Okay, so let's learn about index investing so that you can also benefit from this approach and be able to use this newfound time and energy to do things in life that really matter. Okay, so what is index investing, right? Let's start with that. This is a passive strategy, so you don't have to spend time in the stock market. You can be outside the stock market and still get the best from the stock market. That's what we are focusing on. Focused on replicating the performance of a specific market index, and it could be replicating a performance of a portfolio of indices, as we will see in this course. It's a great option for investors seeking low cost, diversified exposure to the overall market. And this is the strategy that biggest investors in the world have recommended, right from someone like Mr. Jhunjhunwala in India, who always said that for the regular investor who has a life outside of investing, who doesn't want to spend full time into the stock market, it's best to just have a passive strategy or to pick funds that would do well over the long period of time. The same thing has been said by Warren Buffett about the S&P 500. For an average investor, the best option would be to just put the money in S&P 500, and that's what he recommended to his own children as well, who, of course, everyone else, to be very honest, in the world, outside of a few names, as per me, is an average investor. Even actively managed mutual fund managers cannot beat the index in most of the cases, which means that if you're in the lucky few, maybe in the top 5, top 10 investors in the world, you might be better off. And there are people, of course, who are smarter than me, who might be beating the market, but maybe they're beating the market for 6 months. Maybe they are beating the market for 12 months. We don't know what's going to happen in 5 years, 10 years, 15 years. So instead, for most of the other investors, I would just recommend index investing. Now, that being said, I'm not a personal finance advisor, not a financial advisor. So just make sure that you do your own research, but I am going to share what worked with me and what worked for me the best. Okay, so let's move on. What are the biggest benefits of index investing? I'll show you how these differ from from the other forms of investing as well. The first thing is, if you invest in an index, let's say you invest in the Nifty 50, you're basically investing in the top 50 companies of India. So if you were to list all the companies in India by the size, the biggest company to the smallest company, the first 50 companies is going to be Nifty 50. Now, these are going to be large cap companies. When we say large cap, we mean the market capitalization is high. Now, you don't need to really get into what is market capitalization, though you might want to spend a few hours understanding that, or a few YouTube videos if you want. But just to make things simple, what is the biggest company in India? Let's say, for example, right now it's HDFC Bank, or let's say it's Reliance, let's say it's Infosys. If you were to list the biggest one and go down that list, the first 50 would be Nifty 50. Those would be large cap. The next 50 could also be considered, and those will also be large cap. Those would be called the next 50. Now you have a Nifty 100. The next 150 in that list will be mid cap, the next 250 will be small cap, and those are your top 500 companies in India. Now imagine if you put 100 rupees in India. It's almost like saying, okay, if I'm putting 100 rupees in Nifty 500, which means I'm putting money in the top 500 companies of this country, that basically means if the country grows, the economy of the country grows, the money is somehow going to dribble down to these 500 companies, and that's how it works, whether through loans, whether through consumption, people consuming products or services made by these companies, whether it's in India or outside. In some way or the other, when you bet that the country will grow, the top 500 companies of that particular country will grow. So whether in the US, it's S&P 500, which has historically always grown. Same with Nifty in India, which has historically always grown. So that's an opportunity which is basically going to give you consistent returns over a long period of time. And in most cases, for most people, throughout their investing career, right? So the final thing which is important is that they are very cost efficient. If you compare it to an actively managed mutual fund, what happens is there's someone sitting in the fund house who is deciding which company to invest in, and you've got to pay for the salaries of this person. You've got to pay for the fund house giving this person an office space. You've got to pay for all of those things, which all come as something called the expense ratio of that fund house. The expense ratio in case of index funds or ETFs is way lower when you compare it to any actively managed large cap funds. And that's not it. If you read here, they outperform. The index outperforms most of these actively managed mutual funds. So why would you put your money somewhere which doesn't beat the index and is also super expensive? So those all tie back into why index investing becomes the option. Now let's understand the differences between index funds and ETFs. Both of these eventually put the money in the index. So if you find an index fund, let's say for example, you find Navi Nifty 50 index fund. You put your money in Navi Nifty 50 index fund. Your money is going to go in those top 50 companies in India. And depending on the current proportion in which they have the market capitalization, it would go in that way. So for example, let's say HDFC is number one right now and 10% goes to HDFC Bank. So if you put 100 rupees into Nifty 50, 10 rupees will go into HDFC Bank. Let's say 9 rupees go into Reliance, 8 rupees go into Infosys. So these are just examples, but basically your money will be split that way. If HDFC Bank suddenly becomes smaller and Reliance becomes bigger, now the next time you put 100 rupees, Reliance is going to get 10 rupees and HDFC Bank is going to get 9 rupees and so forth. So the money that you're putting in is automatically driven by algorithms going into the biggest companies in the proportion of how big they are. That's all you need to know about how the money goes into these companies, right? And it's going via this algorithm and not via a human person sitting in between who's trying to predict if a company will do better or worse in the future, which hardly works out, right? So that's an index fund. Think of it like a mutual fund that basically automatically puts your money in the Nifty 50. And you could run SIPs on it. If you were to put your money in an index fund, you'd probably use something like Coin, Zerodha, maybe Grow, any of those mutual fund apps to put that money in the index fund. When it comes to ETFs, it's basically the exact same place where your money is growing. Your money is going to the same places, 10% HDFC, 9%, let's say 9 rupees in Reliance, 8 rupees in Infosys, to the same proportion as the Nifty 50. They are both going to put the money in the same place, but the ETF is traded on the stock exchanges. Just like you would buy and sell a stock, you would have to go to Kite, Zerodha, or any of the brokerage apps that you use, if you're using anything else, and put your money there in the ETF. Now, a lot of people say the biggest difference between index funds and ETFs is that you cannot have an SIP in an ETF, which is not true. You could literally start an SIP in an ETF from Kite Zerodha itself. You can check this out. If you want to know that, I can make a separate video on that, but that's what you can do. So that difference goes away. Then what's the real difference between index fund and ETF? To be very honest, it's just the expense ratio. If an index fund equivalent of the same index has an expense ratio of 0.2%, it's just an example, that's a very high expense ratio. For example, it could be 0.02%. Then the ETF would have an expense ratio of 0.01% because the expense ratio gets lower in case of an ETF versus an index fund. That's the only difference to be very honest. There's not much of another difference. Of course, if you think as a trader perspective, ETF allows you to trade, it allows you to buy and sell, but that, I hope, is not a big difference for you if you're a long-term investor. If you're a long-term investor, honestly, you could put your money in an index fund or an ETF. If you find index fund more convenient, if you like the user interface of Coin, for example, versus Kite, you could just do that. It doesn't really matter. For some people, ETFs could make them a little bit more anxious because they're looking at all of these charts, so you could just go the index fund route. What would I recommend as a non-financial advisor if I have to speak to my friend who's not into all of this stuff, who's probably a beginner investing? I would recommend the index fund, okay? Just because I don't want them to get anxious looking at charts and going into Kite, because then it's just a human psychology. It's not about the difference between expense ratios. It's more about, I don't want them to log into Kite and look at stock charts. I want them to be completely passive as you can. So on a scale of active to passive, of course, we are all talking about passive when it comes to both index fund and ETF. But if you were to compare, you could do index fund way more passively than ETF because you don't have to log in anywhere. Like I said, you can still do an SIP via Kite, but you're just prone to looking at other stocks and individual companies, which I don't want you to get into. And the reason why most of the personal finance advice in India talks about individual companies, let's say what HDFC Bank is doing yesterday, what Reliance is going to do tomorrow, what Infosys is going to do next month, is because they want you to keep coming back to their YouTube channels. But with index investing, you could just watch this whole video and maybe just pick a few index funds and ETFs, and then you're set for your life, right? So I can't keep getting you back on my YouTube channel if I keep teaching index investing, which is what I do, because I really don't want you to keep coming back to this content, right? You should learn, implement, and then set it and forget. That's what we're trying to get to. Okay, so how do you select the right index funds? Now I do have 3 different videos on my YouTube channel. One is for a 3 index portfolio, which is the top 3 ETFs to invest in 2024. One is for a 5 index fund portfolio, which is the 5 ETFs to invest. And if you're picking anything more than 5, maybe you want more diversification, then I also have a video on the top 10 ETFs in India. I also have a video on the index fund equivalents, but basically those are the videos that I would like you to watch. I will also share my portfolio. Like, these are my top 3 holdings right now. Okay, so my first one is Nifty 50, Nifty Bs, which is basically close to 30 lakhs of my investment. Next 50 is close to 29 lakhs. So you see that there's not much difference, but the buy value for the next 50 was around 20 lakhs. So it's grown a little bit more than the Nifty 50. And this is why I keep my money more or less equal in Nifty 50 and next 50, because there's slightly more growth opportunity with the next 50 companies. People might say that the top 50 is saturated, but that's not true at all, because the Indian economy is not saturated. It's a fast growing economy. That means top 50 will also continue to grow. So that's still my biggest holding. Next 50 is the second one. And Midcap 150 ETF is the third one. These are all ETFs. You can do your research about these ETFs. Just go on Kite, search for the ETF name, click on fundamentals. That's going to show you the expense ratio and other details about the ETF and how they invest and what they invest in, right? So those are the 3 picks. As you can see, the Midcap 150 is also, the investment amount has been around 15. So my goal was to do 25 lakhs, 20 lakhs, and 15 lakhs. And now the present value is 30 lakhs, 29 lakhs, 22.6 lakhs. And my prediction is, since everyone is making predictions, my prediction is, even if I put 25, 20, 15, they're probably all going to be equal at some point of time, because the Midcap 150 has slightly more opportunity for growth. Now, this kind of portfolio, honestly, I just need to look at it once in 6 months, and I just rebalance it to match my split. And I'm going to talk about what my split is. Now, my split is 40, 30, 20, 10. 40% goes into large cap, which includes your Nifty 50 and Next 50. 30% into mid cap, which is the Midcap 150, and some actively managed mid cap fund as well, which I have. It's the Kotak fund, Kotak Emerging Fund. 20% into small cap through a mutual fund, which is Nippon India Small Cap Fund, is where I'm moving the money now. My investment was mostly into Canara Robeco Small Cap Fund in the past. So now it's diversified between those 2 funds. Why do I recommend actively managed mutual fund for small cap? Because the index is too big of a universe of 250 companies. So I'd rather have someone managing my fund for the small cap category. So 10% finally is for NASDAQ, which is the US index, NASDAQ 100. So as you can see, 40% large cap India, which is Nifty 50, and next 50, 30% mid cap India, 20% small cap, which is the only 20% that's entirely into actively managed mutual fund. So 80% of my portfolio is essentially ETFs. For the 10% US, I invest in the NASDAQ ETF by Motilal Oswal. So that's my entire portfolio basically. What I focus on is, now that I've made this investment and I have a systematic plan to keep investing this consistently, my main goal is to increase my income, right? So I made a separate video on how to go from 0 to 1 crore by making money, not by investing. You need to make money so that you can invest it, and hence it would grow. And how will it grow? By putting it in these ETFs or index funds and then just waiting for a long period of time. And what you're doing while waiting is living life, right? Because if you just keep trading, then you're losing out on life, is how I see this. So those are the 3 most important pieces for long-term wealth creation, okay? Now, this is what you're going to do once you've invested. You're going to monitor your portfolio as such. There are 3 steps to this. The first one is you only review in 6 months. Now, just for making these videos, I have to pull up my console. I have to see my holdings. I might have to see my portfolio a little bit, and then see what I've invested in, what's happening in my portfolio. But I don't, right? I don't do that. I share this with you without any emotional attachment of what these investments are, because I have the set it and forget it mindset and approach, right? So you only need to review it once in 6 months. If you're not making videos like this, then you may not even need to log in. A very good sign of success in the stock market is someone who's forgotten the password to their Kite and Coin and Zerodha or whatever tool that they use, and they remember to check it once a year when their CA or someone tells them to submit a tax P&L. Right? That's a very good sign of success in the stock market, because they are not hampering with the money. They are letting the money grow. They have decided the best places to put the money in, and now they're letting the money multiply over a long period of time. Once you've done that, what do you do in this review? You basically see, okay, if my split was 40, 30, 20, 10, and yours could be very different from me, don't just copy my split, but think about your own split, design your own portfolio. There's videos on my channel about how to design a portfolio as well, which I cover usually at the end of each video. So then you want to get back to that 40, 30, 20, 10 if you actually do want to do that. It's not a compulsion, but you might want to just adjust your split. So you see that, okay, small cap has seen a rally. I could take some of that money, put it into mid cap, right? So that my split is sort of balanced to what I want to be in the long term. So that's called the portfolio reconstitution step, which is the final step. So that's what you do. That's the only thing that you do. And you do this once in 6 months, and you keep doing this. And then you can unsubscribe from Mint and Economic Times and whatever other platforms that you have subscribed from. Okay. There are only 2 challenges that I see in this approach when it comes to index investing. One is there will be cycles. You know, we had a situation in 2020. There'll be situations like that. And you might be jumping from fear to greed, specifically if you consume news. If you don't consume news, you're probably going to be okay. That's another big sign of success, is if you don't consume news, you're going to be more successful. Because yes, there are people who can consume news and be unemotional about it, but most of the people would get emotional based on the news. The second one is lack of patience. You might just want to, when you're looking at it once in 6 months and you see, okay, this thing has gone crazy, 50%, 55% up mid cap. Let me get some of those 8 lakh rupees out, right? I've just made 50 lakh rupees as a return, unrealized P&L. Let me realize 20 lakhs and then try to make that 20 lakhs into 40 lakhs, right? So don't do that, right? This is not Bollywood. So this is what you need to focus on. Keep your patience, stick to it. So only 3 action steps that I'm going to give at the end of this course, which is right now. Let's get into it. The first one is design your portfolio split. So mine is 40, 30, 20, 10. Yours could be different, but design a split. You might want to hedge with 10% in gold, which is something that I do. I also have a gold ETF, which I've covered in the top 10 ETF videos as well. But yeah, design your own portfolio split. The next one is pick your index funds or ETFs. Whatever you do, honestly, it doesn't matter. A lot of people would ask in the comments, Navi fund versus ICICI index fund. It doesn't matter, guys. Just pick one, invest there. People are asking, will Navi shut down after 5 years? Dude, I don't know. But on the other hand, you're buying all of these penny stocks and trying to day trade your way to making 500 rupees a day. That is more likely to lead you to zero compared to this. These are all regulated funds. There are guidelines that they follow. They have high AUMs. There are different metrics to look at. But pick your index funds and ETFs that make you the most comfortable. If you do feel that you hate a particular fund house for some reason, but it has all the right metrics, don't invest in it, because emotionally you may not be comfortable with it. It's fine. Don't pick that one, right? But pick something that you can stick to and then keep investing consistently. That's all I want you to do in your investment journey. And I have seen great results with this, whether it's with me or any of my family members or any of my friends that I've told them about. Again, if you follow this, you can also really focus on living your life instead of living inside the charts. So that's all I have for this course. I hope I've summarized it and made it simple enough for everyone to understand. If you want more mini courses like this, just leave a comment on this video so I can make more. Thank you so much for watching. I'll see you in the next one. Bye.